Gold is breaking the rules of the financial system, not bending them, breaking them, because this rally isn't happening during panic. It isn't happening during collapse. It's happening while governments insist everything is under control. And that contradiction matters directly to you, whether you own gold or not. In 2025, gold didn't creep higher. It exploded, rising roughly 65% in a single year, the strongest performance since the late 1970s. Prices didn't stall at $3,000. They pushed straight through it. Then, in 2026, gold traded near $4,800 an ounce, up more than 75% year over year. That should have been the top. Historically, moves like that end with fear and profit-taking. But here's where the story flips. Every pullback was bought almost instantly. No panic. No rush for the exits. Corrections stopped acting like warnings and started acting like invitations. That's not how speculative manias behave. That's how strategic assets behave when large players are positioning early. So this isn't just about price anymore. It's about why the market suddenly treats gold as something you hold, not something you trade. And once you understand what changed, the number everyone is whispering starts to make uncomfortable sense. What's happening with gold isn't a single event. It's a pattern locking into place. The core shift starts with how gold is being framed. Not as a hedge, not as a panic button, but as what analysts now call a statement trade. That wording matters because it signals intent. A statement trade isn't about timing tops and bottoms. It's about declaring where you don't want your capital to be. The move began when gold reset its floor above $3,000 after that 65% surge in 2025. Instead of mean reverting, the price stabilized. Then momentum carried into 2026, pushing toward 4,800. That alone reframed expectations. But the real signal wasn't the rally. It was the response to weakness. Corrections no longer triggered selling. They triggered accumulation. That tells you the buyer has changed. This is not short-term capital chasing headlines. This is long-duration capital repositioning around risk it no longer trusts. Now notice what hasn't happened. There's been no serious policy shift, no debt reversal, no systemic repair. So the question becomes sharper. If gold is being accumulated this aggressively before anything officially breaks, what is the market already preparing for next? Here's the claim that makes this impossible to ignore. Gold isn't rising because investors are scared. It's rising because they no longer believe the system will self-correct. Look at what's driving the demand. Developed countries are buried under sovereign debt, and there is no visible political appetite to reduce it. None. Not from governments, not from voters. The path forward is permanent deficits, rolled forward indefinitely. That's the backdrop the market is responding to. This is why analysts describe the move into gold as almost embarrassingly basic. Not exotic, not contrarian, just rational portfolio defense. A shift away from assets that depend on fiscal discipline that no longer exists. When capital starts treating gold as a default counterweight to treasuries, something fundamental has changed. And here's the detail that matters most. This behavior assumes debasement without needing a trigger. No crisis announcement required. No emergency meeting. The market is pre-pricing the solution to the debt problem, not waiting for it to be announced. Now notice what's missing from the conversation. There is no credible plan anywhere to reverse the debt trajectory. No timeline, no mechanism. If that absence persists, gold doesn't need hype to move higher. It just needs time. At this point, the move stops being theoretical and starts becoming systemic. Because once capital decides that debt won't be fixed, behavior changes everywhere at once. The escalation isn't loud, it's quiet. It shows up in what gets normalized. Prices that would have been considered extreme a few years ago are now treated as routine checkpoints. Gold approaching 4,800 an ounce should feel abnormal. Historically, moves like that would trigger aggressive tightening, emergency commentary, or coordinated messaging. None of that happened. The rally was absorbed, digested, almost shrugged off. That's the escalation. We've seen this pattern before, not with gold specifically, but with assets that quietly transition from trade to necessity. Once that shift happens, the market stops asking whether prices are justified and starts asking whether exposure is sufficient. Here's why that matters. Normalization removes resistance. When something expensive becomes familiar, it loses psychological friction. That's how floors reset. Not in panic spikes, but in calm acceptance. And here's the unsettling part. Nothing has been fixed underneath this move. The conditions that pushed gold higher are still active. Some are intensifying. So the escalation isn't about speed, it's about permanence. And once permanence sets in, the next leg doesn't need a catalyst. It just needs patience. Here's where the evidence gets harder to dismiss. A massive share of global gold supply is no longer available to the market at all. Central banks have been absorbing close to a third of annual mine production year after year. That isn't trading activity, that's removal. Physical gold taken off the market and locked into reserves. And unlike private investors, these buyers don't care about short-term price. They don't sell pullbacks. They don't rebalance on headlines. They accumulate because the objective isn't return, it's insulation. Now watch the contradiction. While official narratives still frame gold as a legacy asset, state actors are treating it like strategic infrastructure. This buying isn't happening quietly at the margins. It's happening at a scale large enough to reshape supply dynamics. Here's the line that changes how you see this. If 1/3 of new supply is gone before private investors even show up, price no longer reflects sentiment. It reflects scarcity. Notice what this eliminates. The idea that gold needs constant fear to rise. With supply structurally constrained and demand locked in by institutions that don't exit, even modest increases in private allocation force prices higher. This is no longer a market where sellers set the tone. It's a market where available metal is rationed. And once rationing begins, price targets stop sounding speculative and start sounding mathematical. Now the pressure starts stacking faster than the market is comfortable admitting. Because while gold demand is being locked in, another vulnerability is forming just beneath the surface: energy. Global inventories across oil, gas, and diesel are sitting near decade lows, while institutional exposure is unusually thin. That combination matters more than most people realize. This is the classic pain trade setup. When positioning is light and buffers are depleted, even a modest shock forces violent repricing. And energy doesn't stay isolated. It bleeds into everything: transport, food, manufacturing, cost structures. If energy prices spike, inflation doesn't politely reappear. It snaps back. And that immediately feeds the gold trade from a different direction. Higher inflation lowers real rates. Lower real rates remove the opportunity cost of holding gold. At the same time, rising energy costs push mining expenses higher, quietly lifting the floor price of production. This stacks pressure from both sides: monetary, industrial, psychological. And here's the uncomfortable speed factor. These adjustments don't unfold over years. They cascade in weeks, sometimes days. So ask the question the market is tiptoeing around. Now bring it back to where this actually lands. Because when gold moves like this, it isn't just a chart story. It bleeds into everyday life in ways that don't get labeled as gold-related at all. Higher energy costs show up in groceries, in rent, in insurance premiums, in the quiet shrinkage of what your income actually buys. When currencies weaken to manage debt, savings lose purchasing power without ever crashing outright. There's no headline moment, no alarm, just a slow realization that standing still financially now means falling behind. That's the pressure ordinary people feel first, long before institutions adjust their models. This is why gold's behavior matters, even if you never touch the asset. It's signaling a system that's shifting the burden downward. When the top can't absorb risk, it gets distributed. Through prices, through fees, through time. And here's the part most people recognize instinctively. This feels familiar. The sense that stability is being maintained on paper while daily life gets tighter. If that recognition hits, you're not imagining it. If this feels familiar, say so in the comments. Because the signal gold is sending isn't abstract, it's personal. At this stage, outrage stops being useful. What matters is understanding the mechanism. Gold rises like this when systems prioritize control over correction. When debt becomes unpayable, policy doesn't tighten, it stretches time. Rates get managed, liquidity gets extended, risk gets masked, not removed. The system survives by appearing stable while quietly changing the rules underneath. Gold benefits because it sits outside that loop. It doesn't require trust in future discipline. It doesn't depend on promised reforms. It simply exists, immune to incentives that drive policy decisions. This is why the move feels different from past cycles. It isn't fueled by fear of collapse. It's fueled by acceptance of drift. A recognition that leverage, incentives, and political reality all point in the same direction. Toward accommodation, toward debasement spread thin enough to avoid revolt. And here's the unsettling insight. Systems don't fail when people panic. They fail when everyone adjusts. Gold isn't reacting to chaos. It's reacting to consensus. Once that clicks, the rally stops looking emotional and starts looking mechanical. And mechanical moves don't reverse easily. They persist until something breaks the incentive structure itself. And that's where the next decision point begins. From here, the path forward splits, and neither option is comfortable. In one direction, policymakers regain control. Debt stabilizes. Energy shocks stay contained. Confidence holds just enough for capital to pause. In that scenario, gold doesn't crash. It consolidates. It stays elevated because the reset already happened, but momentum cools while the system buys time. In the other direction, drift continues. Deficits expand quietly. Energy pressures leak back into inflation. Real rates stay suppressed, and capital keeps reallocating, not suddenly, but persistently. In that path, gold doesn't spike. It grinds higher, forcing late adopters to chase exposure they assumed they didn't need. Notice what both paths share. Neither requires panic. Neither requires a crisis headline. The move is already in motion. The only variable is speed. And here's the detail that matters most. Markets rarely wait for confirmation. They front-run inevitability. By the time outcomes feel obvious, prices have already moved. That's why this phase feels tense. Not explosive, compressed. Like the next decision has already been made, just not acknowledged out loud yet. Because whatever comes next, gold isn't leading anymore. It's following something already unfolding. Here's the insight that ties all of this together. Gold isn't rising because people expect disaster. It's rising because the system is choosing continuity over correction. And when continuity depends on dilution, hard assets become the reference point, not the exception. The mistake is thinking $7,000 is a prediction. It's not. It's a translation. A rough exchange rate between a finite asset and an expanding set of promises. The market isn't asking whether gold is expensive. It's asking what everything else is being measured against. That's why this story doesn't end with a top or a crash. It evolves, quietly, relentlessly, each adjustment making the last one feel normal. And if this feels like the beginning of something bigger, that's because it probably is. This isn't the gold story. It's the system story. And we're just getting to the part where it becomes impossible to ignore. If you want to stay ahead of where this is going, follow the analysis. The next layer is already forming.